Hi, this is Keith Schneider, CEO of MarketGauge.com, and this is May 7th, 2017 edition of Market Outlook. While the world awaits some pretty important political events, both in France and also in South Korea. So those are two looming elections. The outcomes are pretty much already baked into the markets. It'll be interesting to see if, in fact, Macron wins in France, how the markets react, and will it be sort of buy the rumor, sell the news, or will it actually add on to the already terrific gains that the Eurozone stocks have achieved? But meanwhile, let's take a look at what's happening here domestically in the US. First of all, you can see in terms of volume that accumulation days versus distribution days, after the reset about a week ago, we're in positive territory. So we're slightly in favor of more accumulation days, but the last signal was positive, so things are still in gear, and there's definitely some accumulation across the board in most of the indices, especially in NASDAQ, and now also picking up in the Dow that had been lagging. So overall performance, you can see year to date, all the indices are up. What was leading, though, was the IWM, and that is the lagging index, but definitely turned positive year to date. This last month's action definitely helped. However, one thing to note is IWM still lagging. So this theoretically was going to get the biggest boost with the reorganization in terms of priorities from the new administration, and that is lagging. So in terms of the Trump bump, there is definitely some questions that the market's putting in place, and this is one of those examples. But meanwhile, overall, I'm looking at the trend of the market. All the phases are overall positive in the key indices. Volume's not bad. We're looking okay. Definitely in positive mode. Let's take a look at sectors. And sectors look pretty good this week, put in a really positive performance. One of the things to note is financials, up 1.3%, outperforming the overall benchmark S&P. That's a positive in terms of sort of the Trump effect. The other thing is that semiconductors was the leading sector, up 1.4% this week. Semis have been leading, been the strongest sector since for the last 7 or 8 months or even longer. So leadership is maintained. That's a positive. The other thing to note is technology and consumer discretionary. These are all risk-on type indications, all doing relatively better than the underlying benchmark. Utilities, right, as you can see, even though we regained bullish phase, only up 0.1%. That's a safety play. So the fact that S&P outperforming utilities is a positive. Consumer staples, also only up 0.1% for the week, still underperforming the S&P. Consumer staples, also conservative play, definitely a benefit. And of course, the energy sector down sharply on the lower oil prices. That in itself can help the consumer, but puts a drag on inflation overall. So net, I'm going to look at overall sector performance, definitely improvement this week, and an overall positive. So we're definitely looking good there. So between the volume, the institutional buying, and the overall performance in sectors, still in a very positive mode. Okay, let's take a look at some market hotspots here. And there are a couple things to really note in a big way. Well, first of all, take a look here, right? Spain, up 6.3% for this week alone. Italy, up 6.16%. France, up 5%. And now that's on top of gains right after the runoff election or pre-runoff election in France about 2 weeks ago. So these European stocks, Eurozone stocks, definitely picking up the lead. Look at this over the last 6 months. These stocks are up 23%. They've put in at least half of that just in the last 2 weeks, and that's well outperforming U.S. Stocks. And so the banner, again, handed off to Eurozone stocks and the big cap stocks in the Eurozone. On top of that, we got, as you can see, pressure in oil. Oil services, the 5-day was down even though the market was up. That had a big impact on gold and gold mining stocks as well, as some of the overall anxiety around the world about what's going to happen with the euro and some, I would say, potential easing of tensions in the Korean Peninsula with the upcoming vote in South Korea definitely had an impact over here. Now let's take a look at the market internals, because that's also lending support that we could have a significant rally if in fact there's not an upset with Le Pen. So let's take a look at some of the market internals here. In terms of up-down volume, right here, you can see that we are sort of right in the middle of its zone. So it's got plenty more to move to the upside to get really overbought where we would be concerned. Same thing with the McClellan oscillator, hovering right around a neutral point with the market at new highs. So assuming that we have a breakout again to new highs in the price action, we're certainly not overbought in any sense of the word regarding advanced declines. The McClellan oscillator, which is an indicator that looks at about a month or more, and the shorter term up-down volume over here. Now, in terms of a potential breakdown, this compression zone here and the subsequent breakout on Friday, the bottom of the compression zone and the 10-day moving average, which comes in about 236, or excuse me, 238 or so, is an area to watch. That 238, important support area for your shorter term traders. Okay, let's take a look at our next market internals chart. And this is looking at the same thing on the composite index for NASDAQ. So what do we have here? As you can see, similar. We're in neutral territory in all of our indicators, right? Our middle one is the McClellan turned up slightly over the midpoint here. So you got plenty more to move even on the upside after new closing highs as well. So again, neutral zone to slightly positive in all of these indicators means that they have a lot more room potentially on the upside. And of course, if we get a surprise move under the 10-day moving average and this last couple days of price action where they all coincide, this is now an important short-term support area. So just keep an eye out on that. Keep an eye on that 10-day moving average on all of your key charts, especially the S&P 500 and also the composite. We'll take a look at the QQQs in a moment. Okay, let's take a look at another way to measure the market breadth, and that's looking at the S&P new highs and new low indicator. So one of the things you can certainly see is that we're trading very strong. We did have this bit of a sell-off from these highs here, which corresponded to the sell-off or sort of sideways to sell-off action we had till the middle of April. But now we've moved back up. We've sort of regained our strength back over the 70% level, new highs and new lows. Basically in year, we're pausing at a pretty nice absolute level, which is the 85%. We don't want to start seeing this trail off too much, but overall, I'm going to give this particular indicator a definite, still a positive as well. So as you can see, we got positive readings across a bunch of our market internals, neutral readings on some, and overall trend readings extremely positive overall. So things are in pretty good shape. Let's take a look at a couple more indicators, and then we'll call it a wrap. All right, similar scenario in the NASDAQ 100. Not quite as strong overall in terms of the absolute breadth of this new high, new low ratio. You can see we're trading still under that 85% level, but the trend net still positive as we're hitting new highs, and on an absolute basis still above the 70% level. And so I look at that as a positive as well. Okay, let's take a look at market sentiment in terms of volatility. As you can see, volatility basically in the middle of the Bollinger Band. That's a positive. We don't have any problems here. And net, you can see we're trading at pretty much absolute low levels or close to them, certainly based on recent history, right? We're looking back here. So not surprising considering the market's closed on new highs. And I see no problems here. It's also not at an extreme. Based on the last blowout, the Bollinger Bands really widened out. So we've got a lot more room to see if we can get to excessive optimism or irrational exuberance by hitting the lower end of the Bollinger Bands, but we're nowhere close to there. So in this particular case, we're trading in the middle, under the key moving averages. That's a positive setup as well. Sentiment definitely in favor of the bull trend and not showing irrational exuberance. Let's take a look at another measure of sentiment, and this is looking at 1 month versus 3 month volatility. So there's a couple things to note here. And first of all, this indicator works best at extremes. Best at extremes, right? Here's an extreme. An extreme. An extreme, and also down here. So right now, we've got net a fairly positive trend in strong territory. This is bullish territory in here until it starts to roll over. And again, what we really want to see is an extreme here in sentiment, but we don't have that. So again, overall, it looks like the pause here. You've got this really nice compression zone in the S&P, and again, breaking down under that 238 level would take out the 10-day moving average and the compression zone as well. You can see all of this compression here. So that's a key level to watch because you're taking out two things: actual price action and the moving average of it, right? So certainly you can see this zone right here is critical. And of course, a breakout above the all-time highs confirmed early next week would probably mean that we're on another big run as well. But it'll be interesting to see the short-term patterns. Don't forget to watch the opening ranges, especially we're going to have the results of the election. You're going to get most likely a pretty good size gap Even bigger on the downside would be my expectation if there was an upset. But nonetheless, watch the reaction after the first couple minutes or the first half hour. Use your opening range techniques to follow or fade. All right. Thanks. Bye for now, and see you next week.